Are you a small business owner running an LLC? Then you've probably felt the sting of self employment tax, and you're probably paying it on 100% of your business profits. And unless you've been hiding under a rock, you've also probably heard that there's a quote unquote easy way to reduce this tax bill. Just elect to be taxed as an S Corp. But like most of the quick fix business advice that gets passed around, especially on the internet and social media, the reality is often more complicated than just checking the box. An S Corp might reduce your tax bill, but it will definitely complicate your business structure. My name is Maritza Shay Nelson, and I'm a small business and nonprofit attorney. I help entrepreneurs, founders, dreamers, and innovators pursue their passion without worrying that all the legal stuff, like the rules governing S Corp and whether or not you're compliant, might come back to bite them. When you're a regular W 2 employee, taxes come out of your check automatically. Some of those taxes are the payroll taxes that cover Social Security and Medicare. And when you're a W 2 employee, you pay for about half of that, and your employer pays for about half of it. By default, when you start an LLC and you work for yourself like I do, well, now you're not an employee, you're an owner of the company. Taxes aren't automatically coming out for you anymore. Instead, you pay yourself through distributions or owner's draws, and these are subject to the self employment tax. Now, to be clear, self employment taxes are not an extra tax, okay? You're not paying more just because you're a business owner. They're the same Social Security and Medicare taxes or the payroll taxes that were being paid when you were a W 2 employee. And currently, at least at the time of recording, this is 15.3% of your earnings. The difference now is that instead of having an employer pay half of that 15.3%, you, Mr. or Mrs. Self Employed Person, get to pay the entire 15.3%. You don't have an employer footing part of that bill for you. So, this is where the S Corp election can potentially change things. It changes your legal relationship with your business. Now, the IRS will let you be a W 2 employee of the exact same company. You'll still pay the payroll taxes, but only on your salary, which probably doesn't include 100% of the profits of the company. And half of those payroll taxes will be paid by you just like before, but the other half will be paid by your company as a business expense. So now you're not paying 15.3% on 100% of the profits, but only a portion of those that are designated as your salary. And your employer is paying a part of that. So your company is paying part of that as payroll taxes. But now it's a business expense that also makes your profits a little bit less. So this potentially, if the math works out, can in fact save you some money on taxes. But is that going to work for you? And here's the trick. None of us can answer that for you. That's a question that needs to be settled between you and your accountant. Nobody on the internet knows exactly what your tax situation is, what tax bracket you're in, how much money your company makes, how much you would have to pay yourself as a salary. We'll talk about that in a moment. How much will be left over for potential distributions, and what this will actually look like on your tax return. That's why you need to have an accountant once you get past just having a basic W 2. Every accountant I've ever talked to has said there's a window where they really like this. At some point, you're not making enough money for it to make a difference, and you're just going to end up paying your accountant more money to do your more complicated taxes. And at some point, because the IRS hates all of us, you're making so much money that frankly, it's not going to make a difference anyway. You're still going to owe a lot in taxes. If S Corp status is just an accounting question, which I guarantee you it is, why am I sitting here as a small business lawyer talking about it? Well, one, it's a question that I get all the time. I cannot tell you the number of people I've talked to. We've set up their business, most likely as an LLC because it's the entity type that makes the most sense these days. And then they come back in and go, "You did it wrong. My accountant said I'm supposed to be an S Corp." No, we didn't do it wrong. You're both. For legal purposes, you're an LLC with all the limited liability that comes with. For tax purposes, you're being taxed as an S Corp instead of a disregarded entity. You might notice that when you go check the Secretary of State's website, you cannot create an S Corp with the Secretary of State. It is not a legal entity. It is a tax status. For liability purposes, you still want to have your LLC. But the other reason that I'm talking about it is that any of the fiscal advantages that might come with electing to be taxed as an S Corp are not free. Okay, the IRS is not just giving you a windfall out of the kindness of their hearts. You are trading the incredible flexibility that's inherent in the LLC structure for some very rigid constraints that come with the S Corp rules. An LLC actually has very few formal requirements. It's one of the reasons why they've become so popular in this day and age, and is the reason why we set up 99.9% of new businesses as LLCs. An S Corp, on the other hand, that tax status is governed by the Internal Revenue Code, and that's subject to significant, strict limitations on ownership, equity, and operation. And if you fail to strictly adhere to even one of these limitations, the IRS can terminate your S Corp status. If your S Corp status is terminated, you automatically convert to a C corporation for tax purposes. That's the one with the double dreaded taxation problem, where the corporation files a tax return, pays income tax on its profits for the year, and then when it distributes money to you, the owner, the shareholders, what we call dividends, you get to pay taxes on that money again. That's the reason why we don't really see small businesses get set up as C corporations anymore. So if you lose your tax status with the IRS, you automatically become this the C corp, and you're generally barred from electing S corp status again for 5 years. So while the tax savings with an S corp might be great if it fits your particular circumstances, the compliance burden is absolutely real. And this is the part where I feel like so much of the get rich quick generic business advice that you'll see floating around social media doesn't really talk about. So let's dive into the major pitfalls that cause small businesses to accidentally lose their S Corp status, the rules around who can own your company, and how your ownership is structured. So pitfall number 1, violating the shareholder eligibility rules. While your LLC was flexible enough that virtually anyone could be a member or part owner, whether that's individuals, corporations, other LLCs, your trust, your S Corp must generally only have U.S. individuals as shareholders. So that's either citizens or resident aliens, with very limited exceptions for certain trusts and organizations. So when people come in and say, hey, I want to set up my business through a holding company, so I want to have another LLC own my LLC interest in this company, you can't do that if you're planning to be taxed as an S Corp. We hear this a lot with small business owners that think that they're going to get more liability protection by owning their interest through a holding company. And we've talked about that in another video. You can check that out. But this is a massive mistake for anybody that's actually planning for S Corp taxation. If a business entity, whether that's a corporation or another LLC, becomes a member, your S Corp election is immediately ineligible. So you need to hold your interest in the company in your individual capacity, and that's going to be true for your business partners as well. The second pitfall I see is when a group of owners comes in and they inadvertently want to create a second class of stock. Now, this is arguably the most complex constraint and directly conflicts with the flexibility that we all have come to love about having LLCs. An S Corp can only have one class of stock. So that means all of the outstanding shares, or what we often call membership interests, or sometimes you'll see called units, have to confer identical rights to both distribution and liquidation proceeds. So what am I talking about here? It's not unusual for an LLC to decide to take on some investors to help grow the business. And oftentimes, the way that we'll attract those investors is we'll offer them something called a preferred return in exchange for their capital. So you might say, hey, put in $50,000 into my business. I am going to pay you 7% on that $50,000 and your share of the profits and losses. So that 7% is the preferential return here. Well, the IRS treats that as a separate class of stock. You've now got one class of stock for the investors and one class of stock amongst you and the other co-founders. That automatically terminates your S Corp election. So these are the kinds of structural things that you have to be thinking about well in advance of having that conversation with your accountant. The biggest one that I see often mess up small business owners that are planning to be taxed as S Corps is issuing what's called a profits interest. So we often see this when you bring on some sort of a key service provider and you say, hey, I can't necessarily afford to pay you yet, or I can't afford to pay you a market salary yet. But what I will offer you is equity in the company in exchange for helping me to grow this business. The idea is that if you help me make this company more valuable, then this interest in the company will be worth more money. You'll be getting a share of the profits. In the long run, it's a win-win for everybody. The problem is that the IRS treats a profits interest as a separate class of stock than what you put in when you actually put your money up. And so by doing that, again, you automatically terminate that S Corp election. So if you're in this situation and you plan to incentivize key people or service providers by providing them some equity in the company while also being taxed as an S corporation, then those people will actually have to buy into the company, or you'll need to come up with a different compensation plan entirely. Now, if you're a startup, this may all be fine. You can have them buy in for little or nothing because technically the company's not worth anything yet. But if you've been at this for a while, you've kind of built up some value in the company, and now you're saying, hey, I got to bring somebody in to help me grow this thing to the next level. They don't want to put any money in, but they're willing to come work for me in exchange for a share of the profits. Well, now you've created this profits interest that's going to negate your S Corp election. Now, there is one sort of loophole or exception when we're talking about this having different interests be treated as different classes of stock, and that's when it comes to voting rights. So voting rights alone are disregarded. So while we can't have the investor with the preferred return, we could say, hey, as an investor, you don't get to vote on these things. Only me and my fellow co-founders get to vote on it. You're going to be a silent investor or silent partner and not have voting rights. That's fine. The IRS will allow that. That won't be treated as a second class of stock. The final one we'll sometimes run into that'll mess up your S Corp election are disproportionate distributions. S Corp must ensure that distributions are strictly proportionate to each member's ownership or membership interest in the company. If you somehow change this up and you start distributing funds in a way that's not based on the ownership percentage, then as far as the IRS is concerned, you've created a second class of stock that triggers the S Corp termination. Where I often see this come into play is when the members aren't making distributions based on ownership percentages, but I see this a lot with family-owned LLCs, where suddenly we're distributing money based on who needs what to pay their bills. Oftentimes in that situation, I see business owners treating their business bank account sort of like a joint piggy bank. And we're just taking out money willy-nilly. We're changing the ownership percentages every time we do the tax returns each year. Things are a complete mess. That's also going to mess up your S Corp election. And the IRS is really picky about this rule, even minor differences in timing, like, oh, so-and-so needed some extra money, so we gave them their distribution on the 1st. The rest of us didn't take our distributions until the 15th. Even that minor nitpicky detail can mess up your S Corp election. These ownership and stock structure rules can be very technical, very complex, and the consequences of messing up the tax status can be incredibly severe. You must review your operating agreements and sometimes, if they're structured this way, your shareholder documents. Now, the third pitfall I'm going to talk about before we get out of here are the administrative details and compensation rules that can trip up even the most compliant owners. This is frequently a trigger that will cause you and the rest of the members to actually get audited by the IRS. You see, the entire point of electing S Corp status is to minimize your employment taxes by taking a portion of your profits as distributions instead. However, the IRS requires that you pay yourself, the owner or officer, right, a little bit of both, A salary that is reasonable and appropriate compensation for the services that you render. In other words, you don't just get to decide, hey, I'm going to pay myself a really tiny salary so that I have very little in the way of employment taxes and then take my distributions under more favorable tax rules. Your salary has to be reasonable based on your actual job. So I'm a lawyer. It's probably not reasonable for me to elect to be taxed as an S Corp and say I'm going to pay myself a salary of $5,000 a year. No lawyer in the country works for that salary. The IRS knows that business owners want to reduce their employment taxes by treating as much of their pay as possible as distributions instead of salary, or you start to get into that really funny business where you're misclassifying payments as things like loans to the company, or you're trying to hide personal expenses within your company's books and records. The IRS expects you to treat these payments, especially when they benefit you, as salary that's subject to federal employment tax withholding. So this is again where I say if you've got questions and you're trying to play this funny business, you need to talk to your accountant and you need to have a good one on your side to help you figure this out. The test for reasonable often involves asking, what would you pay someone else to do your job? Right? Like I said, no lawyer in the country is going to work for $5,000 a year. That's just not going to happen. So you need to be able to justify your salary as an owner in the S Corp based on industry standards, your geographical location, the complexity of the business, and the extent of your services. And if you don't pay a reasonable salary, the IRS can reclassify those distributions that you were getting at a better tax rate as wages and then turn around and charge you for the back employment taxes and penalties. If you go out and elect to be taxed as an S Corp, especially if you do it just based on stuff you heard on the internet without really sitting down with your accountant, and you mess this stuff up, whether that's an ineligible shareholder because you thought it would be better to have a holding company, inadvertently creating a second class of stock when you bring on a key service provider, or just not paying yourself enough in actual salary, the IRS will terminate that S Corp election. Your business automatically converts to a C corporation for tax purposes, and now you're paying taxes twice over, and you're barred from making that S Corp election for the next 5 years. Given the complexity of these requirements and the severity of termination that 5 years of C Corp taxation status, careful tax planning, having the right legal structure, and then monitoring to make sure that you're continuing to do everything correctly is absolutely essential for any LLC that wants to maintain its S Corp status. Again, the tax savings might be great, but compliance is non-negotiable. My clients range from startups to growing businesses and nonprofits with nearly 100 employees across a wide variety of industries. If you love what you do and you want to build something amazing without running afoul of the IRS, then let's talk. Check out the link in the description to schedule a consultation, or if you're not quite ready yet, download our 10-pillar post-formation legal checklist to help you spot this and other issues that could be causing problems in your business.